day in y'all waited all day in anticipation of this class, right?
Yes.
We have a couple of minutes. How are you guys finding the class so far?
A lot of information for sure.
Yeah, I know, for this whole course. I mean, but it's not anything you can't handle, right?
Not really. Most of the stuff I know I can vouch that I studied in my accounting course. So it's most of it is familiar. It's just a matter of brushing up and refreshing my memory.
Yeah. And you know, in a lot of instances, there are some nuances. But finance and portfolio management, to a large extent, and when you think about it, it's just a lot of common sense. And people do it in their everyday life. They just don't realize that they're doing it.
That's true.
You know? All right. I'm going to try and start exactly on time tonight because I want to make sure we get all the portfolio management and stay on course with the course. So, having said that, we got 6:30.
Mr. Donovan, before we start, did anyone emailed about the extra class?
Not as yet. I mean, I am still open to it. I mean, I would expect that you all would maybe get together as a group and decide which day bear with me, please. I know it will be an inconvenience to you all. Can it be a Saturday or a Sunday afternoon? Because after Mr. Donovan, I'm finished work all day. I don't know the job, but I just be exhausted in my mind. I like my mind to be the sharpest. So I am open to it. I mean, I have a commitment to you guys more so than just this is a class I teach. I am more concerned about the students with a very good understanding and having a fair chance of getting through this. And I am committed to that. So by extension, I am committed to you guys in your understanding. So rather than people come to me one person, I would rather you guys get together as a group, coordinate amongst yourselves, and decide and get one spokesperson to say, Mr. Darnton, as a group, we've decided that we'd like to do it on this Saturday, on this date at this time, and here are the people who will be participating. Is that a fair ask of me?
Yeah, that's fair.
All right. So I agree. You guys telling me basically what this class, what date it is that you do. Saturdays is a commitment to everybody because that's the day off, that's when you do running around, and so forth and so on. But having said that, I really love you guys just coordinate that. So I'm available. That class, just to be a little bit more specific, I think the class that everybody wants to do is to get work through problems. Am I correct in that assumption? Okay, then I see you guys going back and forth in the chat, so I need you guys here. Today, let's start with derivative products. And I am gonna breeze through this because basically on the exam, okay, there's a lot of feedback. Does it sound like a lawnmower in the background?
I don't hear anything.
Okay. All right. What I would want you guys to understand from derivative products is basically just basically that what they are in terms of a put, a call, and so forth, and get a concept of it. I'm not gonna try and give you problems like if a person bought a call on May 5th and underlying stock goes up, what is the value of the call? Derivatives are they're very, very difficult at this level to understand. So I will derivatives will be more definitions and problems. Going on mutual funds. Funds operated by an investment company that raises money from shareholders and invested in stocks. Basically, what a mutual fund does is allow most investors to not have the funds to invest in a wide array of big equity companies, stocks, or bonds. So what a mutual fund will do, they will buy an array of these products, and then what a person does is buy shares of the mutual fund. And by extension, they are now invested, or their return will be a derivative of the return of the assets that the mutual fund is invested in. Two types of mutual funds, an open-ended mutual fund and a closed. Open-ended, a type of mutual fund where there are no restrictions on the amount of shares the fund will issue. If demand is high enough, the fund will continue to issue shares, no matter how many investors there are. Open-end funds also buy back shares when investors wish to sell. Open-end funds are generally managed actively and are priced according to their net asset value. Some open-ended funds are more conservative and provide consistent returns with low risk, and some are more aggressive in seeking to make capital gains through constant trading. So an open-ended fund is a fund where they are continuously issuing new shares and or buying back some of the shares that investors wish to sell. There are various types of mutual funds depending upon the appetite of the investor. For instance, there may be bond mutual funds, there may be equity mutual funds. Danica, you understand that? Ms. Smith?
Somewhere.
Okay, explain it back to me in your words. An open-ended fund. What's an open-ended fund?
A type of mutual fund where, say I originally invest in it, I can come back at a later time and invest more into it. I guess that's what they mean by continuously issuing new shares to the fund. It's not a one-time investment I can do. I can do more investments into it.
You got it. You nailed it. You nailed it. And so if that's an open-ended fund, a closed fund is when an investment company issues a fixed number of shares in an actively managed portfolio of securities. The shares are traded in the market just like common stock. So what happens is, with an open-ended fund, you go back to the issuing company to buy more funds. To buy more shares, they'll issue more shares. With a closed fund, you have to buy additional shares in what they call the secondary market. So for instance, Anika just said, if she wanted to buy more shares, she can go back and buy more shares from the fund manager in an open-ended fund. In a closed-ended fund, if she wanted to buy more shares, she would then have to go in the secondary market and see if Nikita or Shakira Roachcomb wants to sell their shares. She cannot go back to the issuing company. Advantages of.
So I could ask you a question, Mr. Donathan.
Nothing.
So if I purchase some shares, some bonds or mutual funds in, let's say, CIFP.
Yeah.
In a closed, and if I want to purchase more, I'd have to go to a different company, or I can go through that same company, but a different type of bond. That's
No, if you went back to CIFP, right, in the closed-ended fund, CIFP may arrange the purchase by saying, okay, I'll take your order. And if I find somebody who wants to sell some of their shares, price you wanted to, I'll match you with it. That's closed fund.
Okay. Okay.
However, in the open-ended fund, CIFP would just say, okay, sure, how many more shares you want? And they will issue the new shares.
Okay.
All right, does that make sense to everybody? It's, you know, I could come up to you and ask you, what is a closed-ended fund? You got to tell me, and I'll give you the multiple choices. Is it a fund that issues new shares? Is it a fund with a set number of shares? So you got to know it. Okay, that's what I mean by understanding conceptually what the funds are, or the characteristics of those funds. Ms. Wilson, can you take a shot at the net asset value? What do they mean by that? Open-ended funds generally manage actively and are priced according to their net asset value. Anybody want to take a shot at that? Okay, at the end of every day, a company who issues a fund will tell you what is the net asset value of the fund, or the fund price that you can buy it at. The net asset value of the fund is basically all of the prices of the underlying stocks or bonds. We find an average price of that, and then they take out any expenses involved, and that's the net asset value. It's just a price, it's an indicative price at which you can buy the fund, shares of the fund. Advantages of mutual funds: professional investment management, diversification, liquidity, transferability, variety of types of funds, transferability between funds of a different company. Meaning, let's go back to the example she asked of C5. C5 issues various funds. They issue a bond fund, an equity fund, an international equity fund, and so forth. They're all issued by C5. Now, with C5, what you may want to do is, okay, C5, I have so many shares of bond fund. I want to transfer them into the equity fund. They can do that for you because they manage those funds. Those are C5 funds. However, you can go to them and say, okay, C5, I have so much of the C5 bond fund. I want to transfer that into the Royal Fidelity Equity Fund. No, that's a different family of funds. They will tell you that you'll have to arrange a share of the funds. You'll have to arrange the sale of your C5 funds, and then you got to go to the Royal Fidelity with the proceeds and arrange the purchase of their funds. Disadvantages of mutual funds. Unsuitable for short-term investment. Unsuitable as an emergency reserve. Professional investment management is not infallible. So, in my mind, there's another question. From the list below, tell me what's all the advantages of mutual funds. And I may give you some, is 1, 2, and 3 correct? 1, 3, and 4 correct, and so forth like that. So again, just knowing the characteristics. I'm not going to ask you if the fund is doing this and it has expenses of this, tell me what the net asset value is going to be. I won't do that to you. All right, there's another thing called exchange traded funds. My computer is jumping all over the place tonight. Okay, key features of exchange traded funds. Exchange traded funds, or ETFs, a fund that tracks an index that can be traded like a stock. ETFs always bundle together the securities that are in an index. Investors can do just about anything with an ETF that they can do with a normal stock, such as short selling. Because ETFs are traded on stock exchanges, they can be bought and sold at any time during the day, unlike most mutual funds. Mutual funds can only be bought at the beginning of the day, when the NT and you purchase in at the NAV, net asset value prior to close. However, ETFs will fluctuate during the day, the prices changes during the day, and so forth. So you can buy and sell anytime during the day. Their price will fluctuate from moment to moment, just like any other stock price. And an investor will need a broker in order to purchase them, which means that she will have to pay a commission. There are no sales, loads, or investment minimum required to purchase an ETF. The ETF universe has expanded significantly over the last few years as investors' demand for exposure to global markets has increased. Today, investors can invest in ETFs that represents a basket of stocks listed on indices in China, India, Eastern Europe, Asian, Indian market, in Latin America, emerging markets, etc. Can anybody give me an example of an exchange traded fund that they're familiar with? Anybody? Have you all heard about the Dow Jones Industrial? The S&P 500? Those are exchange traded funds. So again, I may ask you definition. Which of the below definitions best summarizes or tells what an ETF is? And I will give you some things, the characteristics of maybe a mutual fund, closed and open-ended fund, and then an ETF, and you guys can figure it out. Hedge funds. An aggressively managed portfolio of investments that uses advanced investment strategies such as leverage, long, short, and derivative positions in both domestic and international markets with the goal of generating high returns with lower volatility. Legally, hedge funds are most often set up as private investment partnerships that are open to a limited number of investors and require a very large initial minimum investment. Investments in hedge funds are often illiquid, as they often require investors keep their money in the fund for a minimum period and provide redemption quarterly or monthly. Of all the funds we have described so far, hedge funds are the riskiest type of fund. They're very speculative. In module 3, we discussed LTCM, so you are aware that despite their name, hedge funds can carry significant risk. Understanding options. The two types of options are the American option and the European option. The American option allows the owner to exercise at any time before or at expiration, while the European option can only be exercised at expiration. So when you buy a call or a put option, it tells you, amongst other things, what is the exercise date of the option. So I may buy a call option. Let's just say I buy a call option that's exercisable on September 30th of this year. That means you, or the option, when you use the term exercise, that means you can convert the option into the underlying stock or underlying security. In the American option, I can convert that or exercise that option to buy or sell the underlying stock at any time before expiration date, on or before expiration date. Under the European option, I can only exercise an option at the expiration date. There are basically two types of option. A call option. Call option is an agreement that gives an investor the right, but not the obligation to buy a stock, bond, commodity, or other instrument at a specified price within a specified time period. Call option is an agreement that gives an investor the right, but not the obligation, to buy a stock, bond, commodity, or other instrument at a specified price within a specified time period. In other words, I purchase a call option. The call option gives me the right. I buy a call option that's exercisable September 30th. And we're going to be using the American option rule. I buy a call option to purchase some AML shares at $7. And the option expires on September 30th. Okay, I buy a call option. On or before September 30th, what do I have to do? Nikita.
Do you have to do?
Yes. Do I have to do anything?
No.
I buy a call option to purchase AML shares at $7 and now trading, say, at $5. And the option to exercise this right that I have expires on September 30th. What happens on September 30th if the price is at $6? What do I do, Nikita?
I forgot, how much did you buy the call option for?
$7. It gives me the right to purchase from the person who sold me the call option to buy 100 shares of AML at $7.
Mm-hmm.
And I have between now and September 30th.
Mm-hmm.
This option lives or has a life from now until September 30th. What do I do?
You said it's now September 30th or at any point in time?
It's between now and September 30th. You're using the American option rule. Right now, the stock is trading in the marketplace. It's August the 15th, it's trading in the marketplace at $6. Do I do anything?
No, you're not obligated to, because even if you were to exercise, you'll be paying $1 more than what the market price is.
I lose money. That will make
Yeah.
sense. What about it comes on September 30th, an expiration date, and it's still trading at $6.50? Do I do anything?
I would let it expire.
Also, you know about expiring. Nikita, teach the guy. Teach this one. She is right. That's why I emphasize an agreement gives an investor the right, but not the obligation. They're not obligated to exercise this thing. If it's not in their favor, they are not obligated to exercise it. Now, Nikita, suppose it's now August the 25th, AML issued its financials and the stocks jumped to $8.50. What would you do, Nikita?
I would buy it at 7. You exercise my option and buy it at 7.
Why?
Because then I'm buying it at less than market price, so I can gain in value.
Point taken. Point taken, you spot on. So I'll lead you all the way through that, but Nikita basically told you the concept of the call option. Now, let's go to a put option. A put option contract gives the owner the right, but not the obligation, to sell a specified amount of an underlying security at a specified price within a specified time. A put becomes more valuable as the price of the underlying stock depreciates relative to the strike price. Ms. Wilskam, you there? Hi, Ms. Wilskam. You there, Ms. Wilskam? Shakira. Okay, she may be taking a break. Danica, are you there? Ms. Smith, are you there?
Hi, yes, I am.
Okay, this is gonna be yours. Bearing in mind what Nikita said, the call option, this is the way. The call option gives me the right to purchase stock from an individual. The put option gives me the right to sell my price to my stock to the buyer of my put option. Okay. I am the person that holds the AML shares. Okay? My AML shares now is trading at $6 in the market rate. However, I do certain AML at a good year. So I believe when they issue their financials, there may be some downside risk on their stock price. So I can say, being Mr. Smarty Pants, I say, you know what? Just in case this stock go down, I can do a put option, and I can put the put option that the person who buys the put option, I can sell it to them at $5. And the put option also expires September 30th. Between now and September 30th. Now, Danica, suppose on August the 5th, the price of AML is at $6.50. What would I do? Would I exercise the put option? Would I do nothing? What would I do? What would you do?
I would sell it
Why?
because it may be lower by the time it expires.
But would you sell it on August the 5th when it's $6.50?
Yeah, I'll sell it on August 5th.
Anybody else got an opinion on that?
What amount did you say the put option is for? To sell it at what price? It was 60
$5
to sell it at 5?
Yeah.
And it's currently at 650?
Yeah.
I wouldn't do anything,
Why? Give me your logic.
because if I exercise my put option to sell it at $5, if the market is going for $6.50, I'm not gonna get $6.50 if I exercise my put option. I'm only gonna get $5 per share, so I'm gonna lose out.
Okay. Ms. Smith, don't run, Ms. Smith. It's important you understand this.
Mhm.
Okay, so stay with us, Ms. Smith, please.
Oh, I didn't hear you?
No, I said, please stay with us. Did you hear what Nikita said? What
Yes,
her-
I did.
She is correct. Let me tell you why. In a put option, if the holder of the put, if I already hold the AML stock, right? And the current market price is at $6 and it's going up some more to $6.50. Why would I sell it? Remember, your put option was your hedge in case the price goes down. As long as the price is up, you can hold on to the stock. Now let's reverse it. Suppose the share, the earnings come out, the earnings report come out, and they had a less than expected year, and so the market reacts and the share price drops to $5. What would you do then, Ms. Smith?
Share price drops to 5,
Yes,
and my put option agreement is to sell at 5.
yes.
I would sell, because at that point, it may, well, depend on the date. No, I would not sell. If it's not close to expiry, I would not sell,
Okay, Ms. Smith. that's
because
it.
the price could potentially go lower. If it goes to say $4.50 or $4, I would gain if I still holding my put option to
You-
sell at $5.
Who is it, Ms. Smith or just Nikita?
This Nikita. Oh, you said Miss. My last name is Smith too. So sometimes when you say Smith,
Sorry,
I'm thinking you thinking me. Sorry,
I'm sorry. You are-
sorry.
Okay, I can call you Nikita. I can call you Danica, Ms. Smith. Okay?
Okay, noted.
Nikita is absolutely correct. Because remember now, you did the put option just in case the share price goes down. So if the share price in the marketplace is $4.50, but you got a contract that says you can sell it at $5. Oh, run to that, exercise that, there you find it. All right. So they explain it all through that, and you can see the example. I just gave you guys an example. Ooh, forwards and futures. Forward contracts are private agreements between two parties and are not as rigid in their stated terms and conditions. Because forward contracts are private, and I stress the term private, this is not something that's traded in the marketplace. Call options, put options, mutual funds and all of those, and EFTs are all traded in the marketplace. Forwards and futures are private arrangements. A cash market transaction in which delivery of the commodity is deferred until the contract has been made. Okay, although the delivery is made in the future, the price is determined on the initial trade date. Most forward contracts don't have standards and aren't traded on exchanges. A farmer would use a forward contract to lock in a price for his grain for the upcoming fall harvest. Who can give me an example of a forward contract where that is notable in our local environment?
Gas company is a.
I just gonna say that.
I got another particular, who said, that's fair to say that, who that is? Who is that? Okay, who said gas company?
Katura.
Natura. Develop that a little bit more. Give me a little bit specific.
Okay, I mean, like with the current climate, with the gas prices going up and supply issues, if you could lock in, like say, if you had that little speculation and you could lock it in at a lower price now with the anticipation of it going up, that would be, that's what I was thinking.
You are absolutely correct. The example I was looking for was BPL. BPL did it about 2 years ago when oil prices plunged. It was all in the paper how they bought this forward contract to lock in the price of oil prices because of it, they got to buy it in order to produce electricity. They still using fossil fuel. So BPL did that strategy about 2 years back. And they were all bragging about how the price of electricity went down because they locked in this forward deal to buy their oil or at a lower price. So but gas,
Now that you said it, I remember
but
that.
gas companies can do it. That's a good example. And it happens now. What you're saying is because of the war and the uncertainty of oil prices, a lot of companies may be saying, "Boy, look at this war, look like this going on for another 1 year. We better lock in this price right now." And that's by even though the price high, we need to lock in this price right now.
Is up here. He did, yeah.
Okay, somebody has an open phone, and I can hear a lot of background. Okay, so they buy this forward contract on the anticipation that prices of the product or commodity is going to go up. So they want to lock in today's price or the forward contract price. So they have certainty as to what their cost is going to be. Futures, a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or financial instrument at a predetermined future date and price. Futures contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. So futures are traded on an exchange. Forwards are between two parties. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. The futures markets, does everybody understand that statement? Some futures contracts may call for physical delivery of the asset, while others are settled in cash. Anybody want to try to explain that to me? Basically, what it's saying is this. I buy a futures contract to take delivery of 10 bushels of wheat. and I can take delivery on September the 3rd. And the price I lock in is, okay, I'll take the 10 bushels can cost me $20. However, by September 30th, the price going up. The price in the market place is $25 for them 10 bushels. But I can tell the person I bought the contract from, you know what, I really don't need the bushels a week. Just send me the $5 difference. It saves me exercising the contract, taking possession of the week, and then trying to turn around and sell it myself. The futures markets are characterized by the ability to use very high leverage relative to stock markets. Futures can be used either to hedge or to speculate on the price movement of the underlying asset. For example, a producer of corn could use futures to lock in a certain price and reduce risk. On the other hand, anybody could speculate on the price movement of corn by going long or short using futures. Again, very, very technical. You don't have to know that. I just want you to know the difference between a futures and a forward and be able to give me that from a multiple choice point of view to recognize in a problem what is the definition of the future versus a forward. Currency forward contract. Same thing. A currency forward contract is an agreement today to exchange two currencies on a predetermined exchange rate, the forward rate, or on a predetermined date. Same thing. Okay, I know I'm going to London on September 30th. So in London, hypothetically, I'm gonna have to buy pounds. I gotta use pounds while I'm there to pay on my vacation. So I say that, you know what? The pound to the dollar today is $1.57. That means that it takes $1.57 of my dollars to buy 1 pound. Now, I may say, boy, you know, if I wait for the day, if I go to the bank to try exchange my dollars, so I wait until I get in London to exchange my dollars for pounds, boy, the rate may be up to about 180 or something. I better log this in. So I buy a futures contract to buy 5,000 pounds at $1.50 for 1 pound. Same thing. For example, a U.S. electric company, EUC, has entered in a contract to take delivery of a euro 100 million generator in 1 year. EUC wants to know today what this will cost in 1 year in US dollar terms. In order to hedge against the euro appreciating versus the US dollar between now and then, EUC, which is the US electric company, enters into a currency forward contract. The forward exchange rate used in this contract is calculated using the contract concept of interest rate parity. Forward US dollar to Europe equals spot US dollar 1. All it is telling you, there's an exchange rate I could buy at today, or I could buy the futures contract at a predetermined rate. I'm not going to take you to the calculation of trying to work on what is futures rate. Okay, so we're going into the next section, portfolio management. Does anyone have any questions on what we've covered so far or comments?
Mr. Johnson, I have a question just for clarity. The forwards and futures, You said forwards are not traded in the market, so they're private. So that means if the futures are traded on exchange, they're not considered private, or they're also private?
They're not considered private.
Okay,
When they say private, that's like you and Katura entering a deal. That's a forward contract. Only y'all do. That's not traded. You can't sell, Katura can't sell that contract on to no one else or anything. That's a private arrangement between two parties.
okay,
All right?
okay.
So the fundamentals of portfolio management. All right, the fundamentals of portfolio management. Asset allocation is the process of deciding how to distribute an investor's wealth among different countries and asset classes for investment purposes. An asset class is comprised of securities that have similar characteristics, attributes, and risk-return relationships. A broad asset class, such as bonds, can be divided into smaller asset classes, such as treasury bonds, corporate bonds, and high-yield bonds. We will see that in the long run, the highest compounded returns will most likely accrue to those investors with larger exposure to risky assets. You will also see that although there are no shortcuts or guarantees to investment success, maintaining a reasonable and disciplined approach to investing will increase the likelihood of investment success over time. The asset allocation decision is not an isolated choice. Rather, it is a component of a portfolio management process. As we will see, the first step in the process is to develop an investment policy statement or plan that will guide all future decisions. Much of an asset allocation strategy depends on the investor's policy statement, which includes the investor's goals or objectives, constraints, and investment guidelines. What we mean by an investor can range from an individual to trustees overseeing a corporation's multi-billion-dollar pension fund, a university endowment, or an invested premium of an insurance company. Regardless of who the investor is or how simple or complex the investment needs, he or she should develop a policy statement before making long-term investment decisions. Investor life cycle. Life insurance should be a component of any financial plan. Life insurance protects loved ones against financial hardship should death occur before our financial goals are met. The death benefit paid by the insurance company can help pay medical bills and funeral expenses and provide cash that family members can use to maintain their lifestyle, retire debt, or invest for future needs, spouse retirements, children's education, etc. Therefore, one of the first steps in developing a financial plan is to purchase adequate life insurance. Insurance can also serve more immediate purposes, including being a means to meet long-term goals, such as retirement planning, On reaching retirement age, you can receive the cash or surrender value of your life insurance policy and use the proceeds to supplement your retirement lifestyle or for estate planning purposes. You can choose among several basic life insurance contracts. Term life insurance provides only a death benefit. The premium to purchase the insurance changes every renewal period. Term insurance is the least expensive life insurance to purchase, although the premium will rise as you age to reflect the increased probability of death. Universal and variable life policies, although technically different from each other, are similar in that they each provide both a death benefit and a saving plan to the insured. The premium paid on such policies exceeds the cost to the insurance company of providing the death benefit alone. The excess premium is invested in a number of investment vehicles chosen by the insured. The policy cash value grows over time based on the size of excess premium and on the performance of the underlying investment fund. Insurance companies may restrict the ability to withdraw funds from these policies before the policyholder reaches a certain age. Insurance coverage also provides protection against other uncertainties. Health insurance helps to pay medical bills. Disability insurance provides continuing income should you become unable to work. Automobile and home insurance provides protection against accidents and damage to cars or residences. Although nobody ever expects to use his or her insurance coverage, a first step in a sound financial plan is to have adequate coverage just in case. Lack of insurance coverage can ruin the best planned investment program. So to all I've read, all of that, I want you all to go away with one thing. When you do your investment plan, first thing you should start out with is making sure you have adequate insurance. Cash reserve. Emergencies, job layoff, and unforeseen expenses happen. And good investment opportunities emerge. It is important to have a cash reserve to help you meet these occasions. In addition to providing a safety cushion, a cash reserve reduces the likelihood of being forced to sell investments at inopportune times to cover unexpected expenses. Most experts recommend a cash reserve equal to about 6 months' living expenses. I'm going to read that again. Most experts recommend a cash reserve equal to about 6 months' living expenses. Calling it a cash reserve does not mean the funds should be in cash. Rather, the funds should be in investments you can easily convert to cash with little chance of loss in value. Money market mutual funds and bank accounts appropriate vehicles for the cash reserve. That means very liquid type investing that can readily be converted into cash. Similar to the financial plan, an investor's insurance and cash reserve needs will change over his or her life. The need for the disability insurance declines when a person retires. In contrast, other insurance such as supplemental Medicare coverage or long-term care insurance may become more important as a person ages. Assuming the basic insurance and cash reserves needs are met, individuals can now start a serious investment program with their savings. Because of changes in their net worth and risk tolerance, individuals' investment strategies will change over their lifetime. Although each individual's needs and preferences are different, some general traits affect most investments over the life cycle. So they take you through a life cycle and they break it into 3 phases. The accumulation phase. Long-term retirements, children college needs. Short-term house car. Okay, when you're starting out, how you guys are young, this is going to be most of your investment funds are going to be spent after you have done your life insurance and your cash reserve. Okay, you are going to start long term, you're going to be looking at retirement, so you need to start a retirement fund. Children's college education. Short term, you're going to be looking at to buy a house or a car. So you see this phase takes you from age 25 up to about 45. That's what they call this accumulation phase. Consolidation phase. The strategy, your long-term strategy should be retirement. Short-term, vacations, children's college needs. So that may be the focus of your investment strategy from age 45 to about 65 to retire. At 65, you're now retiring. Spending phase or gifting phase. Long-term estate planning, where you have your wills and so forth like that. That's your long-term estate plan. You don't accumulate your wealth, you have your house, your car, your children are in college and so forth. And basically you've now retired from your traditional income. But if you're successful, you will now have investment products that will replace your traditional employment income. So now you're living off of your investment income. Now, you also have some decisions to make. Whether you like it or not, you're all faced with inevitability. You can die. So you need to start your estate planning, getting your wills together, and whatever. Short-term, lifestyle needs and gifts. So short-term, you're going to be spending your money on your lifestyle and so forth. Maintaining your standard of living. Okay, so they go in and they describe it. Let's take a quick walk through the accumulation phase. This is between the age of 25 and 45. Individuals in this phase are attempting to accumulate assets to satisfy fairly immediate needs. For example, a down payment for home, or longer term goals, children's college education, retirement. Typically, their net worth is small, and debt for car loans or their own past college loans may be heavy. As a result of their usually long investment time horizon and their future earning ability, individuals in the accumulation phase are willing to make relatively high-risk investments in the hopes of making above average nominal returns over time. Consolidation phase. Individuals in the consolidation phase are typically past the midpoint of their career, having paid off much or all of their outstanding debt, and perhaps have paid off or have assets to pay their children's college bills. Earnings exceed expenses, so the excess can be invested to provide for future retirement or estate planning. The typical investment horizon for this phase is still long, 20 to 30 years. So moderately high risk investments are attractive. At the same time, because individuals in this phase are concerned about capital preservation, they do not want to take high risk opportunities that may put their current nest egg in jeopardy. Spending phase. The spending phase typically begins when individuals retire. Living expenses are covered by income from prior investments, including employer pension plans. Because their earning years have concluded, they seek greater protection of their capital. At the same time, they must balance their desire to preserve the nominal value of their savings due to inflation. The gifting phase is similar to and may be concurrent with the spending phase. In this stage, individuals believe they have sufficient income and assets to cover their expenses while maintaining a reserve for uncertainty. Excess assets can be used to provide financial assistance to relatives or friends, to establish charitable trusts, or to fund trusts as an estate planning tool. Estate planning, I think, comes after this module, and that we'll get more into that. The portfolio management process. The process of managing an investment portfolio never stops. Once the funds are initially invested, according to the plan, the real work begins in monitoring and updating the status of the portfolio and the investor's needs. The first step in the portfolio management process is for the investor to construct a policy statement. The first step in the portfolio management process is for the investor to construct a policy statement. The policy statement is a roadmap. In it, investors specify the types of risks they are willing to take and the investment goals and constraints. All investment decisions are based on the policy statement to ensure they are appropriate for the investor. We examine the process of constructing a policy statement later in this chapter. Because investors' needs change over time, the policy statement must be periodically reviewed and updated. The process of investing seeks to peer into the future and determines strategies that offer the best possibility of meeting the policy statement guidelines. In the second step of the portfolio management process, the manager should study current financial and economic conditions and forecast future trends. The investor's needs, as reflected in the policy statement and the financial market expectations, will jointly determine investment strategy. Economies are dynamic. They are affected by numerous industry struggles, politics, and changing demographic and social attitudes. Thus, the portfolio will require constant monitoring and updating to reflect changes in financial markets expectations. The third step of portfolio management process is to construct the portfolio. With the investor's policy statement and financial market forecast as input, the advisors implement the investment strategy and determine how to allocate available funds across different countries, asset classes, and securities. This involves constructing a portfolio that will minimize the investor's risk while meeting the specific needs or meeting the needs specified in the policy statement. The fourth step in the portfolio management process is the continual monitoring of the investor's needs and capital market conditions, and when necessary, updating the policy statements. Based upon all of this, the investment strategy is modified accordingly. So just to take a pause, they led you through the 4 steps of creating an investment strategy for the portfolio management process. A component of the monitoring process is to evaluate the portfolio's performance and compare the relative results to the expectations and requirements listed in the policy statement. A policy statement is a roadmap that guides the investment process. Constructing a policy statement is an invaluable planning tool that will help the investor understand his or her needs better, as well as assist an advisor or portfolio manager in managing a client's funds. While it does not guarantee investment success, a policy statement will provide discipline for the investment process and reduce the possibility of making hasty, inappropriate decisions. There are 2 important reasons for constructing a policy statement. First, it helps the investor decide on realistic investment goals after learning about the financial markets and the risks of investing. Second, it creates a standard by which to judge the performance of the portfolio manager. An important purpose of writing a policy statement is to help investors understand their own needs, objectives, and investment constraints. As part of this, investors need to learn about financial markets and the risks of investing. This background will help prevent them from making inappropriate investment decisions in the future and will increase the possibility that they will satisfy their specific measurable financial goals. Thus, the policy statement helps the investor to specify realistic goals and become more informed about the risks and costs of investing. The portfolio management process. Okay. There it is. There's the 4 things in a diagram. So I don't have to go through that again. I mean, they just give you a pictorial of what they said before. Okay, now they talk about an investment policy. Let's get a little bit more specific. Designing an investment policy. The investment policy contains the client's objectives and constraints and the guidelines that the investment manager must follow. Investment objectives. Objectives often receive the most attention from investors at the expense of the other policy considerations. Objectives are determined from a thorough discussion with and knowledge of the client's needs, preferences, and resources. Major considerations are return. In discussing with the manager, the client must determine whether they prefer a strategy of return maximization, where assets are invested to make the greatest return possible while staying within the risk tolerance level, or whatever a required minimum return with certainty is preferable, generating only that much return with the emphasis on risk reduction. In addition, the manager should be conscious of the proportion of current income versus capital gain in light of the client's tax position and needs, as well as the split between current income received as interest versus current income received as dividend. Risk. There are many ways to assess the risk tolerance of a particular investment, from very rudimentary to very sophisticated. Each has its value in measuring what degree of risk the client is prepared to take, and is a vital element in the ultimate design of the portfolio, as it will govern the selection of securities to be included. It is important to recognize the difference between the risk of an individual security and the risk of the portfolio as a whole. Because the risk of a portfolio is less than the average risk of its holdings, the client's risk tolerance should be matched to the risk of the overall portfolio and not to the risk of each security. Inflation. Although most retail clients will need some degree of inflation protection, the extent will vary. A retired person with a long-term horizon and the goal of using portfolio to generate income will be very concerned about what the purchasing power of the cash flow from the portfolio will be. Another person using short-term trading strategies and interested in maximization of capital gain may concentrate less on this particular factor. It is important to remember that there are no certainties with any client. Just because a client is a trader and is of a young age does not automatically mean that they are not concerned about inflation. Careful listening and discussion with the client should always replace assumptions and generalities based on such things as age and wealth. Time horizon. A major factor in the design of a good portfolio is how well it reflects the time of its goals. Fundamentally, the time horizon is the period of time from the present until the next major change in the client's circumstances. In other words, just because a client is 25 years of age and normal retirement is at age 60, does not necessarily mean their time horizon is 35 years. Clients go through various events in their life. each of which can represent a time horizon and a need for complete rebalancing of their portfolio. For example, finishing university, planning for a career change, the birth of a child, the purchase of a home, and many other events besides retirement represent the end of one time horizon and the beginning of a new one. While some major events in the client's life are not able to be predicted, such as a serious health problem or loss of employment, a client's time horizon should still be the period of time from the present to the next major expected change in circumstances. Liquidity can have several meanings, including the net working capital of a business and the ability to sell a security quickly without a significant sacrifice in price. In portfolio management, liquidity means the amount of cash and near cash in the portfolio. Taxation. An investor's marginal tax rate will be paid in part the proportion of income which should be received as dividend versus income, and therefore in part the proportion invested in preferred shares versus other fixed income securities such as bonds. Taxation levels and rates will also guide the choice of tax advantage securities. What they're saying here, you have to bear in mind when you're recommending securities, what are the tax implications of the income derived from those securities? Some securities, such as municipal bonds and so forth, may be tax-free. The income derived from them may be tax-free, whereas other bonds may have a very high tax rate. Market timing. Two approaches to investing include the buy and hold approach and the market timing approach. As the name indicates, buy and hold means long holding periods through various market cycles for long-term growth and income. Market timing involves timing the short-term entry and exit points in the market in pursuit of quick trading gains over and above the commission incurred. Clients generally have a preference for one of these approaches over the other, usually also with a much smaller preference indicated for the other. Some clients very much enjoy the excitement of trading gains and will increase their risk tolerance to accommodate this desire. Other clients usually do not communicate to their IA investment advisor in the above terms of risk, return, etc. Instead, primary investment goals may be stated as a desire to retire at a certain age, the acquisition of a business, a vacation property or sailboat, or the pursuit of some other tangible goal. With care and explanation to the client, the investment advisor can translate such events into the above objectives with the client's full agreement and understanding. Constraints. Constraints provide some discipline in the fulfillment of the client's objective. Constraints, which may loosely be defined as those items which may hinder or prevent the investment manager from satisfying the client's objectives, are often not given the importance they deserve in the policy formation process. Perhaps this is because objectives are a more comforting concept to dwell on than the discipline of constraints. Possible constraints include legal. Certainly, any investment activity which contravenes an act of law, bylaw, regulation, rule, or the criminal code must be considered a constraint. Moral, ethical. Some transactions and investment activities may not be against the law, but should invariably be treated as if they are. While clients may have preferences for certain types of securities, they may also have strong aversion to certain others. For example, perhaps because of a personal conviction, a client may instruct that no alcohol or tobacco stocks be purchased, although it is not normally against the law to purchase these types of securities. And although these securities may fit the client's other objectives perfectly, if the client has instructed the manager to not purchase them, then that order must be respected. Emotions. As full an assessment as possible should be made of the client's temperament. Through discussion and active listening, the manager can fulfill much more of the KYC requirements than if this arena is given only cursory treatment. Investment knowledge. Should a certain strategy be followed if the client clearly does not understand it? For example, writing covered options or using protective puts in other positions may be warranted by the client's circumstances, but the client may not understand them, and particularly will not if they end up losing money. However, serious discussion with the client coupled with active listening can result in a clear agreement on what is permitted. It is the responsibility of the investment manager to explain the investment process to the client, especially where the client is not sophisticated but is interested. Willingness to take risks. Although risk was mentioned above in the context of market volatility, here it relates to the client's level of comfort with volatility in income and volatility in principal. Despite the ability of a client to take risks, their willingness may be lower than expected. If a client is interested in stocks and makes worried calls several times a day for a quote, chances are that this product is not appropriate for them. The extra expected return is not worth it if the client cannot sleep because of the extra risk involved. On the other hand, a client may be quite comfortable with speculative currency or option strategies where their tolerance of risk must be much higher. Ability to take risks. The greater the client's need for income from their portfolio, the lower their ability to take risks and impact their strategic asset allocation of their portfolio. Suppose the client has living expenses in addition to salary, pension, and other income, which requires $20,000 per year in cash flow from the portfolio to meet these expenses. A portfolio may be structured to generate a good total return, but it must also be assured that there is $20,000 in current income from the portfolio, or the client will not be able to live on the income. Other questions related to each of the above constraints can reveal a great deal about the client's attitudes and constraints. However, there is also a place for final overall questions such as, is there anything else which we haven't talked about, which might be important? It is surprising what can come from such a question, such as a family member who is an insider, legal constraint, a serious illness, income and time horizon limitation, size of the account very small or huge borrowing limit, or pending material breakup which somehow did not get discovered in the previous conversation. Having discovered the client's major investment objectives. Having discovered the client's objectives and constraints, the next step in designing an investment policy is to summarize this information in terms of the three major objectives of income, capital gains, and preservation of capital. It is these major objectives that will help determine the appropriate asset allocation for that client. Preservation of capital. One major objective is to have some assurance that the initial capital invested will largely remain intact. If this is the main concern among the three major objectives, the client is effectively saying that regardless of whether a small, large, or nil return is generated on capital, the manager should try to avoid erosion of the amount initially invested. This objective is expressed in constant dollars. The manager should clarify if the portfolio is to cover at least the impact of inflation. The manager should clarify if the portfolio is to cover at least the impact of inflation. There is one simple strategy to make the preservation of an investor's principal fairly certain. Assume an account size of $1 million and the treasury bill rate of 5%. Roughly $950,000 can be invested in T-bills, which are considered risk-free and which will mature in 1 year's time at 100,000, restoring the principal amount. The other 50,000 can be invested in some other venture, even a speculative one, and even if the full 7,000 is lost completely, the investor will receive their principal back. Preservation of capital is derived from several objectives and constraints, including risk, market timing, inflation, return, and emotion. Okay. Income. This major objective refers to a regular series of cash flows from a portfolio, whether in the forms of dividend, interest, or some other form, and it's a broader definition than the basic minimum income referred to as a constraint. The taxation of dividends and interest income will be a major determinant of the split between incomes received from debt or equity securities. This split is decided at the time the asset mix is set. Income is influenced by return, risk, inflation, and basic minimum income, among others. Capital gains. Capital gain is a term related to increase in capital due to sales proceeds being higher than cost basis. That is, selling something for more than the cost. Here, the emphasis is on security selection and market timing, and generally is a trade-off against preservation of capital. Capital gains is the major objective that includes risk, return, market timing, and emotional consideration, as well as others. Investment policy statement. Ideally, the objective and constraints, and perhaps even the manager's style, are written down in a formal document called an investment policy statement. This document forms the basis for the agreement between the manager and the client and is in effect the manager's job description. Policy statements can be either elaborate or quite simple, but most cover the objective and constraints of the portfolio. A list of acceptable securities and a list of prohibited securities, as well as the method to be used for performance appraisal. Setting the asset mix. The next step in the asset allocation process is to determine the appropriate balance among the selected asset classes. Using only cash, fixed income, and equity asset classes, the following are some examples of asset mixes by the client's risk tolerance and investment goals. Capital preservation. This is why the guy don't want no erosion of their initial investment. Investors want to minimize the risk of loss. This is the strategy for strongly risk-averse investors or for funds needed in the short term. Capital preservation. As you can see, they're just giving you an example. Cash should be 20%. Bonds, 50%. Preference shares, 30%. Equities, 15%. In this instance, equities are considered the highest risk. Cash, obviously, the lowest. Bonds are fixed income, have minimal risk because technically bonds are long-term investment. So here it is. Go
Excuse me,
ahead.
Jonathan, this particular portion, where is that in the book, the textbook? I have wealth conservation.
Wealth conservation. What is your wealth conservation thing?
Investors, I was saying the same thing, but the diagram is different.
Okay, that is called capital preservation. That yours is wealth conservation.
Yeah, I don't know if anybody else have the same thing I have.
Can somebody else chip in here and tell me whether they have wealth
I have the same as well.
You have wealth conservation?
Yeah, it has the same definition and the diagram is just slightly different with the allocations. But the definition is the same based on what you have on your screen.
Okay. Miguel, are you there? Miguel? Okay, all right, in a nutshell, what they're trying, Miguel. Miguel, can you hear me? I can see Miguel lit up, but I can't hear his voice. Miguel, are you on mute or what? Okay, I mean, whether it's wealth conservation or capital preservation, I'm gonna get with Miguel to see if they change slides from the version I have. Basically, all it's saying is, if you have wealth preservation, you're trying to preserve your wealth. And so you're averse to risk. So basically, you're gonna invest in assets in terms of the asset classes are gonna be a little bit more risk averse. You're gonna invest more. The portfolio makeup is gonna be more towards fixed income as opposed to equity. What is your next section? You have wealth mind. Do you have income?
Yeah, I have income, the diagram and yeah, I have this, it's the same definition, but the percentages with the bonds and cash, they're not the same.
Okay, what is your percentage from the income for bond?
Let me see. Bond. Well, I have the asset class, equity, fixed income, ultra short fixed income, and the percentage is 30%, 58%, and 12%. But the
Okay.
definition is the same.
Okay, but the concept, I don't want to confuse you, the concept is they're going through an asset allocation here. Basically, depending on what your investment objective is, you will then structure the asset that way. The least riskiest portfolio is the wealth preservation. Then comes income, and then growth is the highest risk type investment strategy portfolio. That will be, no, aggressive growth. That will be for those people who are risk takers. So I don't want to invest. I got to get those diagrams. Please forgive me. But I think you guys get the concept that you have to construct your portfolio on asset classes based upon your interview with the client. You determine basically what is their appetite, what are their investment objectives. At the end of all those diagrams, do they go into this thing, the importance of asset allocation?
Yes.
Okay. So I'm going to read on. The importance of asset allocation. The major reason why investors develop policy statements is to determine an overall investment strategy. The policy statement provides a guideline as to the asset classes to be included and the relative proportions of the investor's funds to be invested in each class. How the investor divides funds into different asset classes is the process of asset allocation. The asset allocations noted above have ranges within which the investment manager can allocate the portfolio's assets within a given asset class. These ranges allow the investment manager to actively manage the portfolio while maintaining the client's asset allocation strategy. Okay, my own, I think they have repeat. Okay, I think that brings us to the end of the asset of the portfolio management module. This is the understanding. Okay, no. So we're going to stop there tonight, and I'm going to open up now. I did a lot of reading tonight. We covered a lot of information. Is there any questions or discussion? Any clarifications I need to give you guys about tonight's material? Comments? Anything? Oh, there I have it. Setting the asset mix. Let's have two versions of it. Wealth conservation. That's what you guys are seeing, right?
Yes.
Okay, all right. Concept's still the same. So you see fixed income. Wealth conservation, fixed income is the largest portion. Equities, which is more risky, is smaller, and ultra short fixed income is almost like cash, and you have cash in it. Income, here you have fixed income securities. Equities, as you could see, equities are taking up a little bit more of the pie. Ultra short is the one's fixed income above the summit. The fixed income is 70%. Now it's dropped to 58 because of more of the income, the balance, and then you have a balanced growth. As you can see, the thing that's going up more, the riskier is the equity portion. And when you go into really market growth, this is where you're gonna get, you don't get capital appreciation from fixed income securities. You get it from equities. You get equities, the equity price could go up, AML could go up in price. And you could get growth from that price as well as dividends they pay. With a fixed income, I mean, at the end of the day, if you hold a fixed income to its maturity, if you invest in $1,000, you will earn interest over the life of that bond, but technically you will get $1,000 back at the end of the term. You ain't gonna get you ain't get $2,000 back as capital. And it just goes on and on. The more risk you're willing to incur, the greater return you're gonna get. Okay, I'm going to stop sharing now. Okay, we're back. Any questions on what we covered today? Comments?
No,
Good?
hopefully.
Okay, all right, folks, then I will leave you guys to get together as a group to tell me if you want the extra Saturday class to work primarily through those problems I gave and any other notes that y'all may come across in reading it again that y'all may still not be clear about. If y'all get together as a group and y'all let me know, I'm committed to be open to it and I maintain that.
I have a question. I may have missed the beginning portion on the extra class discussion. This is our last class? This isn't our last class, right?
No, we do have.
Okay,
We got to
That-
do it normally.
okay. The extra class, it may be more geared towards the time value problems
That's
that we had. Okay,
That's right. I gave y'all, remember I gave y'all some homework. I told you I didn't want to absorb the class time because I have a set program that I need to cover within 4 classes.
okay.
I didn't want to dwell on just going through those questions and maybe not hitting covering all of the material that I'm supposed to cover with you guys in this module. So I have committed to you guys that if you want, I will coordinate with you guys to do an extra class on a Saturday or Sunday afternoon just to go through those problems with you guys.
Gotcha.
Okay?
Okay.
Okay, guys, please enjoy the rest of your evening. Again, you guys, I think you guys have my email address if you want to email me with any other questions or comments. Please feel free to do. All right. Enjoy the rest of your evening and thank you.
Thank you. Same to you.
Good night.
Good night.